Come with me and learn IAS 37 in Paris. IAS 37 is all about provisions. Provisions are a potential liability. So it's debit expense, credit liability. Now if you debit expense, you reduce your tax bill. So it needs to be a proper expense. And IAS 37 has 3 tests to make sure this is a proper expense. Test 1 says there must be an obligation. You must be obliged to have to pay something out. Test 2, there needs to be a probable outflow because you need to be probably going to have to pay the money. And finally, test 3 says there needs to be a reliable estimate of that expense. Okay, so let's say that a company is making losses. It thinks it's going to make losses next year. So there's a liability next year. Can you bring that liability in? Can you bring that provision in now? Well, can you put a reliable measure on the losses? Maybe. Are the losses probable? Yes. Is there an obligation to make losses? No. Because there's no obligation, you can't bring in a provision for future operating losses because you don't have to make those losses. Now compare that to an onerous contract, a contract you wish you never got into because it's a loss-making contract. So let's go through the 3 again. Reliable measure on a contract, yes. Probably going to have to pay the money in the contract, yes. Is there an obligation with a contract? Yes, there is. So you can bring in a provision for an onerous contract because there is an obligation. You don't bring in a provision for future operating losses because there's no obligation to make them. Hope that helps.